In Chapter 7, we're going to look at a lot of different items, mainly dealing with credit card receipts, which is an account receivable basically, and accounts receivable. As a review, we have looked at sales and accounts receivable, sales discount, sales allowance, sales returns. Don't forget, when we sell inventory, we have two entries. We record to sell, and we also record inventory being moved, or cost of goods sold as a selling item, accounts receivable. And now we're going to look at allowance for doubtful accounts, bad debt expense. This video, we're going to concentrate on credit cards, right? You might know this, you might not know this, but you need to know it. Credit card companies, keep finding these lowercase c's, what did I do? Credit card companies charge a fee. Not to you, but to the merchants. So you've probably been to a gas station or somewhere and they said, cash sales, there's a gas station that does it. Is it Exxon? It's like a cash, they're all over, I guess, maybe not Exxon only. Cash price, credit card price, right? So in other words, they're like, pay with the credit card if you want to, but we're going to charge you the fee that we're being charged. We're going to pass that cost on to you. Sometimes you're a retail, a small merchant, and it says, items $10, but if you pay credit card, we're going to increase the price by 3%. So in other words, what's happening is the credit card company charges 3% of the transaction. So they get to keep it. Sell $100, PayPal or whoever keeps 3%. All right, which can really, if your margins are thin, your profit margins are thin, right? You're not making a lot of money off of each item. It can really take out a lot of profit. All right, so here's the journal entries written out where it's a little more explainable. I'm going to let you look at those. I'm going to move on to the example because I think the example is easier to teach. So in this one, I'm going to do number 1, and I'm not going to look at the inventory for part 1, but in part 2, we're going to look at the inventory, okay? So in part 1, wow, I don't know. There's some. If you pay extra, there's an immediate transfer, or close to it, right? I think like there's different tiers. The more you're willing to give the credit card company, the faster they can get the money to you. I believe I have that right. At least we set up a PayPal account with something about a year ago for a tournament we were working on, and PayPal offered, hey, pay us a little bit more money, we'll get the money to you quicker. Like 2 days, 4 days, don't care. All right, maybe if I was in business, I could crunch the numbers and make a decision if it's worth paying that fee. I don't know, but for us it wasn't. All right, so in this example number 1, 20,000 merchandise, it costs 15,000. Again, we're not going to do the inventory entries in part 1, we wanted to. And the net cash receipts from sales are immediately transferred to the seller's bank account. The MasterCard company charges a 5% fee. Now, it could be MasterCard. Your credit card could say, any name of company you want on it, and it could be a MasterCard. Or it could say any name of company or bank you want, and it says Visa on it. So, or it could say Barclays, right? So it doesn't matter the name of the company so much as company is actually running the credit card behind the scenes. All right, so in this case, we had sales of 20,000, so credit sales of 20. And I know I'm doing this out of order. Actually, you know what? Let me do this. Let me just do this. I'm going to do it the way I would do it. All right, so blank journal entry, right? I don't care where my lines end up when I'm doing a blank journal entry like this. I just skip a few lines and I might have a couple extra lines above. I don't care personally. So we're going to credit sales for 20,000. That might be the first entry I do. I know it's a credit. And anything above it or below it could be another credit. Anything above sales could be a debit, right? All right, so I know that I'm getting the money immediately, right? So I'm getting the money immediately. Yeah, let me get a pen out. All right, so it's 20,000 $20,000 is a sales transaction. And those people at MasterCard, right? MasterCard, they're keeping 5%. Well, 5 times 20,000 is $1,000, right? So that means I'm going to get to keep. That means I'm going to get to keep 19,000. Oh, well, I goofed that up. I'm doing something I don't normally do. All right, so I'm going to keep 19,000, and that means the credit card company, I'm not going to get it. They're going to keep it. It's going to be but it's an expense. I chose to allow to accept credit card. My company did, or our company, your company, whatever. And it's an expense. So we'll debit credit card expense. So the debits of 19,000 and 1,000 total to equal the credit of sales of 20,000. Let's look at one that's a little more complicated, okay? Well, we're going to allow it to be more complicated. It is as complicated, but we're gonna do it all. Sold merchandise, sold 5,000 in merchandise. It costs 3,000 on assortment of credit cards. In other words, we just add them all up, and we got. It can be called credit card receivable if you want. It can be accounts receivable. All right, and our provider says, "Look, you accept them, and it's a 4% charge." Okay, so just like we did before. I did that, y'all. I made a mistake. Probably looking at your copy and was like, that 200 is not there on my copy. Sorry. All right, so credit card expense is $200. And sales are $5,000 and accounts receivable is $4,800, just like you read it. And again, I can't reiterate this enough. This is literally how I work it. I do sales first. I don't know why, that's the way I do it. And then I take and I go in and I do the math. 5,000 times 4%, right? And you know it's $200. Most of y'all probably did it in your head already. Plus you already saw the answer. So that's the credit card expense. And sales would be 5,000 minus 200 or 4,800. All right, so so I write down sales. I skip a line, write down sales, accounts receivable, sorry, 4,800. And then I come in here and put my credit card expense. So that's how I do it. I skip all around. I just like a work. It's like a puzzle. I do my journal entries more like a puzzle. I don't necessarily have to start to the top and work my way down. I can start at the bottom, go to the top line, skip a line, do the middle. Different ways of doing it. But we're going to do everything. So cost of goods sold was $3,000, right? So we'll debit cost of goods sold and credit inventory for $3,000. What about when we get the money? Right? Well, later on, a few days later, we're going to get the money. So we'll debit cash 40. Now, remember, the money's coming from MasterCard or Barclays or Visa, whoever's handling this, right? So we'll debit cash for $4,800 and we'll credit accounts receivable for $4,800. So credit card is just like an accounts receivable, except the credit card company is going to get a cut. All right? They're going to get a cut. They pay us. Now, has their borrower paid them? Or you know, if you have a credit card, you're a borrower. Have they paid them? Probably not. They're just sending the money, their own money. They're hoping that the money they lent basically will be repaid by the person with the credit card. All right, I think I'm going to stop it here. That's a long video on credit cards, and I don't want to do much more with credit cards. So after this, we'll be focused on accounts receivable and bad debts. This concludes the first video in Chapter 7.